You've got a beautiful home, the kind that makes your neighbors do a double take. Hardwood floors, kitchen straight out of a Pinterest board, and mortgage payments that could fund a small country. But when you check your bank balance, you're debating whether you can buy that double double from Tim Hortons every day of this week. Sounds familiar? Well, welcome to being home rich but cash poor. Your net worth looks great on paper, but your wallet is actually screaming for mercy. And this isn't just some rare financial blunder. It is becoming an increasingly common problem in big, expensive cities like Toronto and Vancouver. Home prices have skyrocketed over the years, and people are spending decades paying off mortgages so large that they can make your head spin. And what's the result? Well, many homeowners are putting off saving for retirement, even having an emergency fund in some cases, and they just avoid thinking about all the financial pitfalls that can become real. So, what can you do? Why stress about a problem that won't go away? A problem today will be a problem tomorrow unless you're able to do anything about it. So, in today's episode, we are going to dive deeper into what it means to be home rich and cash poor and how to avoid falling into this trap. And if you're already in it, how to climb your way out. So, whether you are years away from retirement or already in your golden years, there is enough for you to take away from this episode. So, how do you know if you are home rich and cash poor? Well, these are some symptoms that you can look out for. It is like being that friend who drives a luxury car but can't afford gas. So, these are the red flags. Your mortgage payment eats up 40% or more of your income. Your savings account, if you still happen to have one, is collecting dust. Your investment accounts do not have much of a balance either. You maybe make occasional contributions to your RRSP to save on some tax, but are nowhere near exhausting the available room. TFSA, maybe the same story. Lots of room, but little to fill it with. You're racking up credit card debt or relying on your line of credit much too often. You keep borrowing more and more against the home and keep extending your amortization or the repayment period. You think equity takeout is a financial strategy, not a warning sign. You have postponed home repairs because you can't afford them. I think you get where this is going. And so, to make things real, let's meet Dave and Karen. They bought their dream house in Toronto, but now every month is a financial juggling act. Vacations? No more. Retirement savings? What's that? Instead, they are planning to refinance just to stay afloat. They love their home, but in their current state, they are house rich, stressed, and likely going to work until they are in their 80s, or maybe even never retire. Is that a life that you aspire for? What can you do to avoid such a fate? If you got time before retirement, you have options to course correct. And here are a few things that you can think of. You don't need to wait till retirement to downsize or right size. You do not have to live in a mansion to build wealth. A slightly smaller home can mean huge savings on mortgage, utilities, maintenance, and other costs. There will still be stress, most likely, but you will probably not be miserable always. Increase your cash flow. I know this can be annoying or something you don't even want to desire for, but maybe that option is to rent out a part of your home. Maybe think about your basement apartment. Short-term rentals are not so good an idea nowadays, given the tax disadvantages associated with the operation because of recent regulatory changes. If you got a guest room collecting dust, maybe it's time to make it work for you. Or maybe consider getting a side hustle to augment your income. Make extra payments, even small ones add up. Refinance strategically to get a lower rate while keeping your payments steady. If your net worth is only tied up in your home, that is very risky. Start investing outside of real estate. For those financially savvy homeowners, a loan conversion strategy can help transform your mortgage into a wealth building tool while reducing your taxable income. So, this is how it works. Firstly, you have to establish a readvanceable mortgage. Now, this mortgage setup allows you to borrow against your the equity in the home as you pay down the principal. As you build equity, you then take out a loan through the credit facility or the line of credit associated with the mortgage. The borrowed funds are then invested in income generating assets like real estate or rental property, stocks, or maybe even a small business. The interest that then becomes due on this loan becomes tax deductible. The tax refunds and the potential investment returns can then be used to pay down your mortgage faster, and you can keep repeating this cycle. This strategy works best for those in a higher tax bracket, as the tax deductions are much more substantial. A homeowner in a 40% tax bracket will see greater benefits than someone who is in a 25% bracket. Again, a word of caution, it is not for everyone. Since this involves leveraging debt to invest, it requires a disciplined approach. Market fluctuations can impact your investments. So, seeking guidance from a tax professional, financial planner, and a knowledgeable mortgage broker is crucial to implementing the strategy. For retirees, being home rich and cash poor is a bigger challenge because you do not have much income flexibility. But don't worry, there are still a few solutions that you can explore. Firstly, unlock your home's equity smartly. HELOC can be a good solution. It's good for short term liquidity, but you need a repayment plan. Again, qualify for one while you still have a sufficient income, so most likely before you retire. Reverse mortgages. While often misunderstood, a reverse mortgage can be a strategic tool for retirees who need additional cash flow without selling their home. Many retirees hesitate to consider a reverse mortgage due to misconceptions. But the truth is, you still own your home. The lender does not take ownership, they only have a charge on the property, just like a traditional mortgage. It's a non recourse loan, which means you will never owe more than the home's appraised value when the loan is settled. No monthly payments are required. So, this can help ease financial stress while preserving other investments. Your government benefits remain intact. Funds received from a reverse mortgage do not count as income, meaning you won't have to pay tax on it, and nor would it affect your eligibility for any government benefits. Plus, the flexibility. You are in control of how much to borrow, how often to borrow, and also if you want to repay a portion or the whole amount if you happen to have surplus funds. For retirees looking to age in place while maintaining their lifestyle, a reverse mortgage can be a valuable tool, especially when other lending options are unavailable due to income limitations. Downsizing was once a classic strategy for retirees looking to free up cash and reduce the housing cost. But the reality today is a bit different. As property values continue to rise across the country, especially in major cities, retirees may find that downsizing doesn't bring the same financial relief it used to. Even smaller homes in desirable areas are now often priced similar to the larger ones, meaning selling your current home may not leave you with as much surplus as you would have expected. That said, if you find yourself in a position where downsizing still makes sense, well, perhaps moving to a less expensive area or a home with a lower maintenance cost would be great. Can still free up equity. But keep in mind, the financial outcome might not be as dramatic as once it was. Lastly, you can always optimize your government benefits as well. Maybe delaying your CPP and OAS to a later age can get you bigger payments later on. Use RRSPs and drift payments strategically so you don't outlive your savings. If you take nothing else from this episode, remember your home should be a financial asset, not a financial burden. Build cash flow strategies so you're not house poor. Plan for the long game. Don't assume your house will save you in retirement. If you enjoyed this episode, share it with a friend who's stressing about money and living in a house that's way too big. And as always, reach out if you need mortgage advice or financial strategies tailored to your situation. Stay financially smart, and I'll catch you in the next episode. Take care.